There is a secret language in the world of money, a dialect spoken only by the masters of the game. It's a language not of stocks and bonds, but of structure and flow. While the average person is taught to think about earning, saving, and investing, the truly wealthy understand a fourth, almost mystical concept: the art of using other people's money. Not borrowed money, which comes with the heavy price of interest and the ticking clock of repayment. No, this is something far more profound, a source of capital that is often free, sometimes even profitable, and almost always permanent. This is the story of the greatest financial engine ever built, the core reactor inside Berkshire Hathaway, and the principle that allowed Warren Buffett to turn a struggling textile mill into a $500 billion fortress of wealth. This principle is called insurance float, but its power extends far beyond the arcane world of insurance. It is a universal key, a way of seeing business and value that, once understood, will permanently alter your perception of how fortunes are truly made. The vast majority of investors, even seasoned professionals, skate right past this concept. They see a liability on a balance sheet and recoil, missing the colossal cash-generating asset hiding in plain sight. They misvalue entire companies, entire industries, because they don't speak the language of float. Today, you will learn that language. You will learn to identify the hidden engines in businesses that provide them with free, investable capital. This isn't just an academic exercise, it is a financial transformation. By the end of this journey, you will possess a new and powerful lens for stock picking, a method for uncovering the next generation of compounding machines that are designed, from their very DNA, to win. This is the final promise of value investing, the master key that unlocks the deepest level of business model analysis. The story of this colossal financial empire begins not in a glittering skyscraper in Omaha, but in the decidedly unglamorous, ink-stained offices of a small, struggling insurance company. To understand the genesis of the Berkshire Hathaway fortune, we must travel back to the year 1967. The world was a different place. The Dow Jones Industrial Average was hovering around 900 points, the Nifty 50 growth stock craze was just beginning to bubble, and a 37-year-old Warren Buffett was running a small investment partnership in his hometown, already a millionaire but far from the global icon he is today. He was a practitioner of deep value investing, a discipline learned at the feet of his mentor Benjamin Graham. He hunted for cigar butts, cheap, discarded stocks that had one last profitable puff left in them. But Buffett was evolving. He was beginning to realize that buying mediocre companies at wonderful prices was a difficult, often grueling business. He was starting to hunt for something better, wonderful companies at fair prices, and in 1967, he found the key that would unlock that new world. He found National Indemnity Company. The foundational anecdote of the Berkshire Empire is the acquisition of National Indemnity and its sister company, National Fire and Marine Insurance Company. They were owned and run by Jack Ringwalt, a friend and fellow Omaha native. Ringwalt was a character, brilliant, eccentric, and by 1967, tired. He was ready to sell. Buffett, through his investment partnership, had already been a shareholder, so he knew the business intimately. He knew it wasn't just another sleepy insurer. One day, Buffett walked into Ringwalt's office and, after some brief pleasantries, asked him a simple question: "What's your price?" Ringwalt, perhaps not taking him entirely seriously, scribbled a number on a piece of paper and pushed it across the desk. Buffett glanced at it and said, "I'll take it." The deal was done in minutes, with no teams of lawyers, no prolonged due diligence, no investment bankers. The price was $8.6 million. For that price, Buffett didn't just get an office building, some desks, and a portfolio of insurance policies. He got something far more valuable. He got the float. At the time of the purchase, National Indemnity had about $6.7 million in tangible book value. On the surface, paying $8.6 million, a premium of nearly $2 million, might have seemed like a departure from his strict, buy-below-book value Graham-style investing. But Buffett saw what others didn't. He saw that the company held tens of millions of dollars in what is called insurance float. This is the money that policyholders pay upfront in premiums which the insurance company then holds and invests for its own benefit before eventually paying out claims down the road. In the case of National Indemnity, which specialized in unconventional long-tail insurance like commercial auto liability, the time between collecting the premium and paying the claim could be years, even decades. This created a massive revolving pool of capital. It was money that wasn't his, but that he could control. It was a liability on the balance sheet, technically owed to policyholders, but in practice it behaved like a permanent, interest-free loan. The $8.6 million purchase price gave him control over a much larger pool of investable assets. This was the moment the light bulb didn't just go on, it exploded. He realized that the business of insurance wasn't just about underwriting, the process of pricing policies correctly to make a profit. It was a business that, if run with discipline, could generate an ever-increasing amount of free money to invest. He had stumbled upon the greatest leverage machine in the financial world. The purchase of National Indemnity wasn't just another transaction, it was a fundamental shift in strategy. It was the moment Buffett moved from being a stock picker to a capital allocator on a grand scale. The float from National Indemnity became the seed capital, the initial fuel for what would become the Berkshire Hathaway compounding machine. Every subsequent acquisition, from See's Candies to Coca-Cola to the BNSF Railway, was funded, in one way or another, by this ever-growing river of cash that began in the humble offices of Jack Ringwalt's insurance company. The underlying psychological principle at play in this pivotal moment was Buffett's extraordinary ability to overcome what is known as confirmation bias, combined with his relentless application of first principles thinking. Confirmation bias is the tendency for people to favor information that confirms their existing beliefs or hypotheses. In the 1960s, the investment community had a rigid, confirmed belief about insurance companies. They were evaluated based on their underwriting profit and their stated book value. The float, the giant pool of temporarily held cash, was viewed almost exclusively as a liability, money owed to others. This was the industry dogma. Analysts saw unearned premiums and loss reserves on a balance sheet, and their brains registered debt. They were trapped in a conventional framework, their analysis confirming the pre-existing belief that liabilities are bad and assets are good. They were pattern matching, not thinking. Buffett, however, operated differently. He approached National Indemnity not by asking, "How does this fit the pattern of a typical insurance company?" but by asking a series of first principles questions. What is a business? A business is a mechanism for generating cash. Where does the cash come from in this specific business? It comes from customers, in the form of premiums. When does it come in? It comes in today, up front. Where does the cash go? It goes to pay for claims. When does it go out? It goes out tomorrow, or next year, or in 10 years. What happens to the cash in the meantime? We, the company, get to hold it. What can we do with it while we hold it? We can invest it for our own benefit. Is there a cost to holding this cash? If we are good at underwriting, if our premiums collected exceed our claims and expenses paid, there is no cost. In fact, we are being paid to hold this money. By breaking the business down into these fundamental truths, he completely sidestepped the confirmation bias of the entire market. He didn't see a liability. He saw a massive, self-replenishing, cost-free pool of capital. He wasn't looking at an insurance company. He was looking at a machine designed to gather assets. This ability to discard industry labels and deconstruct a business down to its core cash flows is a rare psychological skill. It allows one to see value where others, blinded by their own confirmed beliefs and mental shortcuts, see only risk and complexity. It's the difference between looking at a car and seeing a metal box with wheels, and looking at it and seeing an internal combustion engine, a drivetrain, and a steering mechanism. Buffett saw the engine afloat, while everyone else was just polishing the hood. So how can we translate this powerful psychological shift into a practical, applied mental model? We can call it the look-through method. a blueprint for finding hidden value by ignoring superficial labels and tracing the flow of cash. It's a step-by-step process that any investor or entrepreneur can use to analyze a business with the clarity of a first principles thinker. Step 1 is to consciously and deliberately ignore the industry label. Forget that you are looking at an insurance company, a software company, or a retailer. These labels come preloaded with cognitive biases and conventional wisdom. Your goal is to see the business as a unique system for moving money, not as a member of a category. Step 2 is to become a cash flow detective. Your sole mission is to trace the journey of a dollar through the business. Ask the critical questions. When does the company receive $1 of cash from its customer? Is it before, during, or after the product or service is delivered? Then, ask, when does the company have to pay out cash for the costs associated with generating that dollar? Does it pay its suppliers, employees, and other expenses before or after it gets the customer's cash? Step 3 is to calculate the delta, the time and amount gap between cash in and cash out. Is there a period where the company is holding its customers' money before it has to pay its own bills? This duration is the key. A company that gets paid 30 days after delivering a product it paid for 60 days earlier has a negative cash flow cycle. But a company that gets paid today for a service it will deliver over the next 12 months is holding a pool of cash. This is a potential float-like characteristic. Step 4 is to rigorously evaluate the cost of this held money. Is it free? Is it profitable? For an insurer, if underwriting profits are positive, the cost of float is negative. They are being paid to hold the capital. For a software company selling annual subscriptions, the cost is essentially zero. Compare this to a company that has to borrow money from a bank at 5, 6, or 7% interest to fund its operations. The competitive advantage is staggering. By applying this look-through method, you stop being a passive observer of financial statements and become an active analyst of the underlying business mechanics. You start to see that some businesses are designed like buckets that leak, constantly needing to be refilled with outside capital, while others are designed like reservoirs, constantly collecting capital that they can then use to irrigate their own growth. To truly appreciate the genius of Buffett's approach, we must examine its antithesis, the path of the 99%, the mindset of the surface-level analyst. This is the investor who, in 1967, would have looked at National Indemnity and walked away. The surface-level analyst operates on heuristics and conventional wisdom. Their process is a checklist of common metrics. First, they would look at the price-to-earnings ratio. For a sleepy insurance company, it likely wouldn't have looked extraordinarily cheap. Next, they'd check the price-to-book ratio. As we saw, Buffett paid a premium to book value, a cardinal sin in the eyes of a dogmatic Graham disciple. This analyst would have immediately flagged it as expensive. Then, they would look at the underwriting performance. If National Indemnity had a year or two of mediocre underwriting results, the surface-level analyst would see only risk and volatility. They would write a note saying inconsistent underwriting discipline and move on. Their critical failure is that their entire analysis is based on looking in the rearview mirror, using standardized metrics that fail to capture the unique structural advantage of the business. They see the unearned premiums on the balance sheet, and their brain, trained by accounting conventions, screams, liability. They view it as a debt owed, a future cost, a negative. They completely fail to grasp the dual nature of float. It is simultaneously a liability to policyholders and a massive, investable asset to the company's shareholders. The 99% fail because they are playing a two-dimensional game of checkers on a three-dimensional chessboard. They see the pieces on the board, the reported earnings, the stated book value, but they are blind to the third dimension of capital flow and time. The disastrous consequence of this shallow analysis is opportunity cost on a colossal scale. The investor who passed on National Indemnity in 1967 didn't just miss out on a decent investment. They missed out on the seed that grew into the mightiest oak in the financial forest. They missed the chance to own the foundational asset that would fuel decades of compounding at a rate that would make Midas blush. They chose the comfort of conventional metrics over the hard first principles work of understanding the business's true economic engine, and in doing so, they walked away from one of the greatest wealth creation opportunities in history. The direct financial connection of this single decision is almost impossible to overstate. When Berkshire Hathaway, then just a shell of a textile company, officially acquired National Indemnity, its balance sheet was transformed overnight. Let's quantify the impact. The purchase price was $8.6 million. In return, Berkshire received not just the $6.7 million in book value, but control over an investment portfolio funded by a float of approximately $17.3 million. Think about that. For a net cost of less than $2 million over book value, Buffett gained control of a $17 million investment portfolio that was, for all intents and purposes, free. It was like buying a wallet for $2 and finding $17 inside. This float wasn't static. It was a living, growing entity. As National Indemnity wrote more policies with disciplined underwriting, the pool of investable cash grew larger and larger. This immediately solved Buffett's biggest problem as an investor: scale. A small partnership can be nimble, but it's hard to deploy large amounts of capital. With the insurance float, Buffett now had a permanent, ever-expanding river of capital to direct. This changed his entire investment strategy. He no longer had to hunt for tiny, obscure cigar butts. He could now take large, meaningful stakes in wonderful businesses. The financial statements of Berkshire Hathaway began to tell a new story. Before 1967, it was the story of a dying textile business. After 1967, the balance sheet started to bloat with cash and investments, funded by the corresponding liability of the insurance float. This structure provided incredible leverage, but without the traditional risk of debt. A loan has a maturity date and covenants. If your investments turn down, the banker still comes calling. Float, however, is patient. As long as new premiums are coming in to replace paid claims, the pool of capital remains stable or grows. This allowed Buffett to take a truly long-term view, buying assets during market panics when others, funded by nervous bankers or fleeing investors, were forced to sell. The acquisition of National Indemnity was the financial equivalent of attaching a rocket engine to a go-kart. It was the single transaction that provided the permanent capital base that would fuel a 50-year journey of unprecedented portfolio growth and wealth building. To truly grasp the power of this money machine, we must move beyond its discovery and dissect its mechanics. What precisely is this float that acts as the central reactor of Berkshire Hathaway? And how did a man named Ajit Jain, operating from a small office in Stamford, Connecticut, elevate this concept into an art form, creating a financial fortress that could withstand any storm? The mechanics are, on the surface, deceptively simple. An insurance company collects premiums from its customers today. It pays out claims to those who suffer a loss at some point in the future. The time lag between the receipt of the premium and the payment of the claim creates a pool of money, the float. This money does not belong to the insurance company. It is a liability, technically owed to its policyholders. However, the company gets to act as a custodian for this money, and crucially, it gets to invest it for its own benefit. The entire game of insurance, from a financial perspective, is to make this float as large, as long-lasting, and as cheap as possible. This is where the magic and the danger lies. The foundational anecdote that illustrates the mastery of this mechanism is not a single large acquisition, but the career of one man, Ajit Jain. In 1986, Buffett hired Jain, an Indian-born engineer with an MBA from Harvard, who knew absolutely nothing about insurance. Buffett saw in him a mind of unparalleled rationality and a genius for calculating risk. He handed Jain the keys to a fledgling reinsurance operation and essentially told him to build. What Jain built was Berkshire Hathaway Reinsurance Group, arguably the most powerful and profitable insurance operation the world has ever seen. Jain's specialty became super cat reinsurance, insuring against massive, catastrophic events that other insurers were too terrified to touch. Think mega hurricanes, massive earthquakes, or widespread terrorist attacks. Other companies would run from these risks. Jane, with his engineer's brain, ran towards them, but only at the right price. He understood that low-probability, high-consequence events were the most mispriced risks in the market. A perfect illustration of his creative genius was the deal he struck with Quicken Loans for their billion-dollar bracket challenge during the NCAA basketball tournament. The prize was $1 billion for a perfect bracket. The odds were astronomical, perhaps 1 in 9 quintillion. No normal insurance company would know how to price such a policy. Ajit Jain did. Berkshire Hathaway underwrote the risk, collecting a handsome multi-million-dollar premium from Quicken Loans. In return, Berkshire took on the $1 billion liability. They collected the cash up front. The chance of them ever having to pay out was infinitesimally small. For the cost of a few days of calculation, Berkshire added millions of dollars of pure, cost-free float to its coffers. This is the game at its highest level. It's not just about passively collecting premiums on auto insurance. It's about actively seeking out large, complex, and mispriced risks that no one else has the capital or the courage to take on. Ajit has written policies on everything from a player's potential to hit a certain number of home runs to insuring against the cancellation of major sporting events. Each time he collects a premium that is, in his calculated view, far in excess of the actual risk, adding to Berkshire's mountain of investable cash. Buffett himself has said that if he, Charlie Munger, and Ajit Jain were on a sinking boat with room for only one to be saved, the shareholders would want them to save Ajit. That is the measure of the man who perfected the mechanics of the money machine. The underlying psychological principle that allows Ajit Jain and Buffett to operate on this level is their complete mastery over two powerful cognitive biases: loss aversion and asymmetric risk assessment. Loss aversion, a concept pioneered by psychologists Daniel Kahneman and Amos Tversky, describes how for most people, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. An ordinary insurance executive, when presented with the opportunity to underwrite a $1 billion prize, is paralyzed by loss aversion. Their mind doesn't focus on the high probability of winning the premium. It fixates on the terrifying, albeit minuscule, possibility of losing $1 billion. The potential pain of that loss looms so large that it completely distorts their decision-making, causing them to demand an irrationally high premium, or, more likely, to simply refuse to take the risk at all. They see the headline number $1 billion and panic. Buffett and Jain operate on a different psychological plane. They are masters of assessing asymmetric risk. They are not fearless. They are rationally fearless. They understand that risk is not just about the size of a potential loss, but the probability of that loss, multiplied by its size. For the bracket challenge, the probability was so close to zero that the expected financial loss was actually quite small, far smaller than the premium they could collect. They saw the asymmetry, a very high chance of a medium gain, the premium, versus a near impossible chance of a catastrophic loss. The rest of the market, crippled by loss aversion, saw the reverse. This psychological fortitude allows Berkshire to act as a financial first responder. When a crisis hits, like the 9/11 attacks or Hurricane Katrina, other insurers panic. Their loss aversion goes into overdrive, and they flee the market, raising prices to astronomical levels for the few policies they are still willing to write. For Berkshire, this is a moment of supreme opportunity. They enter the market when fear is at its peak, and they use their fortress-like balance sheet to write massive policies at highly profitable rates, collecting enormous amounts of float precisely when others are too afraid to do so. They are exploiting a market-wide, fear-driven cognitive bias, turning the irrationality of others into a source of cheap, long-term capital. This professional-grade approach can be distilled into an applied mental model for any investor wanting to analyze an insurance business, a blueprint for calculating and evaluating float quality. This isn't just about finding float, it's about determining if it's a valuable asset or a ticking time bomb. Step 1 is the basic calculation. You need a company's annual report, specifically the balance sheet. Find the liability lines for losses and loss adjustment expenses, which are loss reserves for claims that have happened but not yet been paid. And Unearned premiums, premiums collected for coverage not yet provided. Add these together. From this sum, subtract premiums receivable, premiums billed but not yet collected, and reinsurance recoverables. The resulting number is the company's float. This is the pool of money they are holding. Step 2 is to calculate the cost of that float. This is the most crucial step. You need the income statement. Find the underwriting loss or underwriting profit. This is the premiums earned minus the claims and expenses paid. To get the cost of float, you take the total underwriting loss or profit and divide it by the average float for that year. If a company has a float of $10 billion and an underwriting loss of $100 million, its cost of float is 1%. They are essentially paying 1% interest on a $10 billion loan. If, however, they have an underwriting profit of $100 million, their cost of float is negative 1%. They are being cost-paid sums $100 million a year to hold $10 billion of other people's money. This is the holy grail. Step 3 is to analyze the stability and duration of the float. Is it growing consistently year after year? A growing float is a sign of a healthy, disciplined insurer. What kind of insurance are they writing? Long-tail lines like medical malpractice or workers' compensation are more valuable because the time between collecting the premium and paying the claim can be many years, giving the company a very long time to invest the money. Short-tail lines like auto insurance have a much quicker payout cycle. A company with a large, growing, long-tail float at a negative cost is one of the best businesses in the world. This blueprint moves you from a novice who says insurance is complicated to an advanced investor who can precisely measure the quality and value of a company's core economic engine. Now, let's examine the antithesis, the disastrous path taken by the 99% of insurance companies that fail to master these mechanics. Their cardinal sin is chasing premiums while ignoring risk. For many publicly traded insurance companies, the executive team is under immense pressure from Wall Street to show growth. The easiest way to show growth in insurance is to increase the top-line number, gross premiums written. So they embark on a reckless campaign for market share. They lower their underwriting standards. They cut their prices to levels that are not commensurate with the risk they are taking on. They write policies for anyone with a checkbook, hoping that they can make up for the inevitable underwriting losses with investment gains. This is a fool's errand, and it almost always ends in disaster. A classic example is the near collapse of AIG in 2008. AIG's financial products division, in a desperate chase for profits, wrote hundreds of billions of dollars worth of credit default swaps on subprime mortgage securities, essentially insuring against a housing market collapse. They collected relatively small premiums for these contracts, adding to their apparent earnings, but they took on a risk of almost unimaginable magnitude. They were picking up pennies in front of a steamroller. When the housing market inevitably crashed, the claims came due, and AIG was rendered instantly insolvent, requiring a massive government bailout. They had a mountain of what looked like float, but its cost wasn't just positive, it was infinite. They had built their house on a foundation of sand, prioritizing short-term reported profits over long-term disciplined risk assessment. This is the fate of insurers who lack the psychological fortitude to say no. They chase business in competitive, low-margin areas, leading to a high cost of float. They get addicted to the investment income generated by the float and forget that their primary job is to be disciplined underwriters. When a major catastrophe hits, or when the investment markets turn down, their weak foundation crumbles and they discover that their asset was actually a poison pill. The direct financial connection of mastering these mechanics is starkly visible on Berkshire Hathaway's financial statements. It is the tangible evidence of their superior model. Let's look at the numbers, because they are truly staggering. In 1970, shortly after the acquisition of National Indemnity, Berkshire's insurance float was a mere $39 million. By 1990, it had grown to $1.6 billion. By the year 2000, thanks in large part to the acquisition of General Re and the genius of Ajit Jain, it had swelled to over $27 billion. As of the end of 2022, Berkshire Hathaway's insurance float stood at an almost incomprehensible $164 billion. Let's put that number in perspective. $164 billion is more than the entire market capitalization of companies like Disney, Netflix, or Wells Fargo. And this capital has been, on average, completely free. Over the past 2 decades, Berkshire's cost of float has been consistently negative. They have been paid, on average, billions of dollars a year for the privilege of holding and investing this colossal sum of money. Think about this from a capital allocation perspective. Warren Buffett wakes up every morning with a $164 billion pool of capital that costs him less than nothing, has no maturity date, and is almost certain to grow larger next year. Compare this to any other company in the world. If a normal company wants to make a major acquisition or invest in a new factory, it must either use its retained earnings, issue new stock, diluting existing shareholders, or borrow money from a bank or the bond market, incurring significant interest costs and restrictive covenants. Berkshire faces none of these constraints. The float is a permanent, self-replenishing source of firepower. This is their ultimate competitive advantage. It is the financial superpower that allows Buffett to be greedy when others are fearful, to provide liquidity to the market in times of crisis, and to acquire entire businesses for cash without batting an eye. The numbers on the page, the $164 billion liability on the balance sheet, tell the story of how a disciplined focus on the mechanics of the money machine created the most powerful and durable financial entity in modern history. The true genius of the float concept, however, lies in its universality. While Berkshire Hathaway perfected it in the world of insurance, the underlying principle, getting paid by your customers before you have to pay your costs, is a structural advantage that exists in many different industries. Once you learn to see it, you will start spotting these hidden engines everywhere, in businesses that look nothing like an insurance company on the surface. To find the source of this insight, we can look to another one of Buffett's legendary investments, a story that predates his ownership of Berkshire but perfectly illustrates his ability to see float in unexpected places: the American Express salad oil scandal. The foundational anecdote for this expansion of the float principle occurred in 1963. Buffett was still running his small partnership. A company called Allied Crude Vegetable Oil, a major customer of American Express's warehousing division, defaulted on its loans. It was discovered that their massive tanks of salad oil, which were used as collateral for the loans, were mostly filled with seawater. It was a massive fraud, and American Express, which had guaranteed the warehouse receipts, was on the hook for millions. Wall Street panicked. The consensus was that the scandal would bankrupt the venerable company. The stock price was cut in half. Amidst the chaos, Buffett did what he always does. He went out and did his own research. He didn't just read the headlines. He went to restaurants, banks, and travel agencies. He observed that people were not stopping their use of American Express travelers' checks or credit cards. He talked to merchants and customers and realized that the company's core business, built on a foundation of trust, was completely unharmed by the scandal in a different division. But his key insight went deeper. He realized that the true value of American Express wasn't just the fees it charged on cards. It was its massive, unrecognized float. Millions of people around the world would buy American Express travelers' checks. They would hand over their cash today and might not use those checks for weeks, months, or even years. Some checks would be lost and never cashed. During that entire time, American Express had the use of that money completely interest-free. The same was true, to a lesser extent, for their charge card business, where they held money in transit between the customer and the merchant. Buffett recognized that American Express was, in essence, a financial institution with a giant, non-interest-bearing deposit base, just like an insurance company. The market saw a damaged brand. Buffett saw a float-generating machine whose franchise was intact. He invested a staggering 40% of his partnership's assets into American Express stock. Within 2 years, the stock had more than tripled. He had looked past the temporary scandal and identified the durable, hidden cash-generating engine that everyone else had missed. The psychological principle that allowed Buffett to make this brilliant move is his immunity to a bias known as functional fixedness. This is a cognitive bias that limits a person to using an object only in the way it is traditionally used. A famous experiment involves giving someone a candle, a box of thumbtacks, and a book of matches, and asking them to attach the candle to a wall. Most people try to tack the candle directly to the wall, which fails. The solution is to empty the box, tack the box to the wall, and place the candle inside it, using the box not as a container for tacks, but as a shelf. They are functionally fixed on the box's purpose as a container. The same thing happens in investing. In 1963, the market was functionally fixed on American Express's identity as a travel and entertainment company. They saw it as a provider of cards and checks. Their analysis stopped there. Buffett, free from this bias, saw the function of the business, not its label. He saw that the function of traveler's checks was not just convenience for the traveler, it was a mechanism for gathering massive amounts of interest-free cash for the company. He saw the business for what it truly was, a float business disguised as a travel services company. This ability to see beyond the stated purpose of a product or company and understand its true economic function is a hallmark of elite business model analysis. It requires you to ask, what business is this company really in? Is a software company really in the business of selling code? Or is it in the business of collecting annual subscription payments up front, a float business? Is a big box retailer really in the business of selling goods? Or is it in the business of using its scale to get paid by customers long before it has to pay its suppliers, a negative working capital business? Overcoming functional fixedness is the key to unlocking this deeper level of insight and finding float in the wild. This leads us to our applied mental model for this pillar, the float-like business finder. This is a practical blueprint for identifying companies with these hidden cash engines, companies that possess the same structural advantage as a well-run insurer. Step 1 is to scour the balance sheet for the line item deferred revenue or unearned revenue. This is the single most powerful indicator of a float-like characteristic outside of insurance. It represents cash that a company has received from customers for services or products that it has not yet delivered. Think of a software-as-a-service SaaS company like Adobe or Microsoft. When a customer pays $240 for a one-year subscription to their software, the company gets all the cash on day one, but it only earns $20 of that revenue each month. The remaining balance sits in deferred revenue. This is a massive, interest-free loan from its entire customer base, which it can use to fund operations, research, and development. Step 2 is to analyze the company's cash conversion cycle, or CCC. This metric measures how long it takes for a company to convert its investments in inventory and other resources into cash. The formula is days inventory outstanding, how long inventory sits on the shelves, plus days sales outstanding, how long it takes to collect from customers, minus days payable outstanding, how long the company takes to pay its own suppliers. For most companies, this number is positive, but for a few exceptional businesses, it's negative. Think of a company like Costco or Amazon. They sell their inventory very quickly. They collect cash immediately from customers at the register or online, but they use their immense bargaining power to negotiate long payment terms with their suppliers, often 60 or 90 days. A negative CCC means the company is essentially receiving an interest-free loan from its suppliers to fund its entire inventory and operations. Step 3 is to investigate other, more subtle forms of float. Look for large balances of customer deposits or gift card liabilities. A company like Starbucks, for example, has billions of dollars loaded onto gift cards and its mobile app at any given time. This is, in effect, a multi-billion-dollar zero-interest loan from its caffeine-addicted customers. By using this three-pronged approach, hunting for deferred revenue, calculating the cash conversion cycle, and looking for customer deposits, you can systematically identify businesses that have cracked the code of using other people's money to fund their own growth. The antithesis to this deep analysis is what can be called the growth at all costs SaaS trap. This is the path of the 99% in the modern tech world. Many modern software and subscription-based companies have the task structure of a float business but lack the discipline to make it a true advantage. They successfully collect cash upfront from customers, creating a large deferred revenue balance. This is their float. But then, they fall into the trap of believing that top-line growth is all that matters. They take that beautiful interest-free cash from their customers and immediately incinerate it in a bonfire of inefficient spending. They pour hundreds of millions into sales and marketing with a questionable return on investment, hire thousands of employees they don't need, and subsidize their service at unsustainable levels, all in the name of capturing market share and boosting their annual recurring revenue (ARR) figures. They have the cash-gathering front end of a Berkshire Hathaway, but the cash-burning back end of a dot-com flameout. They possess the form of a float business, but none of the substance. The result is that despite having a structurally advantageous business model, they are perpetually in need of external capital, constantly raising new rounds of venture capital funding, or issuing new shares to stay afloat. They are running on a treadmill, with their spending always outpacing their efficient cash generation. The disastrous consequence is that they never achieve true financial sovereignty. They are beholden to the whims of the capital markets. When the funding environment is good, they can continue their cash-burning ways. But when the market turns, as it always does, and investors start demanding profitability, they are left with a bloated cost structure and no clear path to self-sufficiency. They had a hidden engine, but chose to flood it rather than harness its power. The direct financial connection of finding a true float-like business is profound and quantifiable. Let's take a real-world example like Microsoft. When you look at their balance sheet, you will find a line item under liabilities called unearned revenue. This figure is consistently in the range of $40 to $50 billion. Let that sink in. Microsoft has received, in cash, roughly $50 billion from its customers for services, like Office 365 subscriptions and Azure cloud services, that it has not yet delivered. This is a $50 billion zero-interest, non-recourse loan from its global customer base. How does this translate into a tangible financial advantage? First, it dramatically reduces their need for traditional financing. While a competitor might need to issue bonds and pay billions in interest to fund a new data center, Microsoft can use the cash that its customers have already given them. This interest expense savings flows directly to the bottom line, boosting profitability. Second, it provides enormous flexibility for capital allocation. This $50 billion is available today for strategic acquisitions, like their purchase of Activision Blizzard, for massive investments in R&D, like their partnership with OpenAI, or for returning capital to shareholders through dividends and stock buybacks. It creates a virtuous cycle. The strong subscription products generate float. The float funds innovation and acquisitions, which in turn creates even stronger products that attract more subscribers. This is a self-funding flywheel of growth. When you compare a company with this structure to a traditional manufacturing or consulting business that has to fund its operations for weeks or months before getting paid by a customer, the difference is night and day. One is swimming upstream against the current of working capital needs, while the other is being carried forward by a powerful river of customer-funded cash. This is a competitive advantage that is both enormous and, to the untrained eye, completely invisible. Having established the principle of float and how to spot it in the wild, we must now become fluent in its native language, the language of the financial statements. It's one thing to understand the concept of a hidden engine, but it's another thing entirely to be able to pop the hood on any company, pick up your tools, and diagnose its health and power. This requires a deeper level of financial analysis, an ability to perform an X-ray on a business and see the flow of cash that doesn't always show up in the headline earnings numbers. We must learn to read between the lines of the balance sheet and the statement of cash flows to find the tangible proof of these powerful business models. Our foundational anecdote for this deep dive into financial statement analysis is Buffett's acquisition of See's Candies in 1972. This purchase is often cited as a turning point in his investment philosophy, the moment he truly embraced buying wonderful businesses at fair prices over mediocre businesses at cheap prices. But it was also a masterclass in understanding float-like characteristics on a smaller, more seasonal scale. See's Candies, a beloved West Coast chocolatier, was a mature, slow-growth business. On the surface, it looked decidedly unexciting to the typical Wall Street analyst. But Buffett and Munger saw something special. They saw a brand with incredible pricing power, but they also saw a business with a beautiful working capital cycle. See's has two massive sales peaks during the year, Christmas and Valentine's Day. In the weeks leading up to these holidays, customers flood the stores, paying cash for boxes of chocolates. This creates a huge influx of cash into the company's coffers. However, the costs associated with producing that candy, the sugar, the chocolate, the labor, the packaging, were paid to suppliers on more traditional terms, often weeks or months earlier or later. This created a significant, albeit temporary, pool of float. Every year, See's would generate a mountain of cash that it didn't immediately need for its own operations. For a standalone company, this cash might just sit in a bank account earning minimal interest, but as part of the Berkshire Hathaway ecosystem, it became something far more powerful. The few $1 million of excess cash generated by See's Candies each year could be immediately swept up to the corporate level in Omaha and redeployed by Buffett into other investments, buying shares of Coca-Cola or adding to their position in the Washington Post. See's wasn't just a candy company. It was a small, reliable cash geyser that gushed money at predictable intervals, money that could then be allocated to its highest and best use anywhere in the growing Berkshire empire. Buffett paid $25 million for See's, a price that seemed high to many at the time. But that initial investment has since produced over $2 billion in pre-tax earnings for Berkshire, almost all of which was sent to Omaha for Buffett to reinvest. He didn't just buy a brand, he bought a cash flow machine. The psychological principle that Buffett masterfully exploited here is the defeat of anchoring bias. Anchoring is a cognitive bias where an individual depends too heavily on an initial piece of information offered, the anchor, when making decisions. In finance, analysts are constantly anchored to conventional valuation metrics. They look at a company like See's in 1972 and anchor on its price-to-earnings ratio, its book value, or its slow revenue growth. They would say, this is a candy company, and candy companies in this growth stage should trade at 8 times earnings. The asking price is 12 times earnings, therefore it is expensive. Their entire framework of analysis is anchored to these simple, backward-looking multiples. They are incapable of incorporating a qualitative factor like brand loyalty or a structural factor like the seasonal float into their rigid valuation model. Buffett, on the other hand, was not anchored to these conventional metrics. His anchor was something far more fundamental: owner earnings and the return on invested capital. He asked not, what is a fair P/E ratio for a candy company, but rather, how much cash will this business generate for me over the next 20 years, and how much capital do I have to leave in the business to generate that cash? He saw that See's required very little incremental capital to grow. It was a business that could increase its prices every year without losing customers, and it gushed cash. Therefore, the return on the net tangible assets required to run the business was astronomical. The surface-level analysts, anchored to their spreadsheets, saw an overpriced, boring company. Buffett, anchored to the reality of cash generation, saw a financial masterpiece. He was willing to pay what looked like a high price because he understood that the quality of the business and its incredible cash-generating characteristics made it an absolute bargain in the long run. This brings us to our most granular and practical blueprint yet, a deep dive into financial statement analysis for float. This is your step-by-step guide to becoming a financial X-ray technician. You will need a company's most recent 10K or annual report, which is freely available on their investor relations website or the SEC's EDGAR database. Step 1. Open the 10K and navigate to the consolidated financial statements. Your first stop is the consolidated balance sheets. Step 2. Within the balance sheet, go to the Current Liabilities section. This is where the treasure is buried. Scan this section for those magic keywords we've discussed: deferred revenue, unearned revenue, customer deposits, subscription liabilities. Note these numbers and, more importantly, track how they have changed over the past 2 to 3 years. A large and growing deferred revenue balance is a powerful green flag. Step 3. Now move to the consolidated statements of cash flows. This statement is arguably the most important of the three. It shows the real movement of cash, stripped of accounting fictions. Find the section called Cash Flows from Operating Activities. Within this section, look for a line item called Changes in Working Capital, or a series of line items detailing changes in specific assets and liabilities. You want to see a consistent, positive cash flow contribution from increases in your target liabilities, like deferred revenue and accounts payable. This is the smoking gun, proof that the company's operations are being funded by its customers and suppliers. Step 4. Now it's time to do your own calculation of the cash conversion cycle, CCC. You'll need data from both the balance sheet and the income statement. You'll calculate days inventory outstanding, days sales outstanding, and days payable outstanding. A quick search online will give you the precise formulas for each. Combine them to get the CCC. Don't just calculate it for 1 year. Track it over a 5 or 10-year period. You are looking for a trend. Is the CCC consistently negative? Is it getting more negative over time? A company with a durable, negative, and improving CCC is a business that is becoming more and more efficient at using other people's money to grow. This is the holy grail of financial statement analysis for float. The antithesis of this deep, forensic accounting work is the all-too-common practice of ignoring the balance sheet. The vast majority of retail investors and even many professionals live and die by two things: the income statement and the stock chart. Their entire analysis consists of looking at revenue growth, net income, or worse, adjusted EBITDA, and the squiggly line of the stock price. They are obsessed with stories and narratives. They hear that a company is disrupting an industry. They see that its revenue is growing at 50% a year, and they buy the stock, often at any price. They completely ignore the balance sheet and the statement of cash flows. To them, these documents are just boring, complicated tables of numbers. They would never spot a company with a negative cash conversion cycle because they aren't even looking at the inputs required to calculate it. They wouldn't notice a ballooning deferred revenue account because their focus is glued to the top-line revenue number on the income statement. The disastrous consequence of this neglect is that they are flying blind. They are buying the sizzle without ever checking to see if there's any stake. A company can have explosive revenue growth but be burning through cash at an alarming rate. It can report a profit on its income statement due to accounting rules, while its cash flow statement reveals a business that is bleeding cash. By ignoring the balance sheet, they fail to assess the company's financial health, its solvency, and its hidden structural advantages or disadvantages. They are buying the story, while the smart money is busy analyzing the underlying economic engine. This is why so many retail investors get wiped out when the market narrative shifts from growth at all costs to a flight to quality. The companies with strong balance sheets and real cash flows endure, while the story stocks with weak balance sheets and massive cash burn evaporate. The direct financial connection of this analytical skill is the ability to uncover a massive competitive advantage and a source of hidden value that is not reflected in standard valuation metrics. Let's do a quick, tangible walkthrough with a real company like Dell Technologies in its prime. For years, Dell was a master of the negative cash conversion cycle. Their build-to-order model meant they held almost no inventory. When a customer ordered a computer online, Dell would collect the cash immediately via credit card. They would then use that cash to order the components from their suppliers, Intel, Microsoft, etc. Because Dell was such a massive customer, they were able to demand very favorable payment terms, often paying their suppliers in 60 or 90 days. Let's quantify this. Imagine their CCC was minus 30 days. This means that for a full month, Dell was holding its customers cash before it had to pay for the parts to build the computer. It was essentially receiving a 30-day, interest-free loan from its suppliers on its entire cost of goods sold. If Dell sold $50 billion worth of computers a year, this translated into a permanent, revolving, interest-free loan of over $4 billion. This float from their working capital cycle gave them a colossal advantage. They could fund their rapid growth without needing to borrow money or sell stock. They could invest in more efficient manufacturing. They could put pressure on their competitors who had to tie up billions in inventory and accounts receivable. An analyst who only looked at Dell's P/E ratio would have missed this entirely. They would see a low-margin hardware business. But the analyst who did the financial X-ray, who calculated the cash conversion cycle, would see Dell for what it truly was: a masterfully engineered cash machine. This hidden value, derived directly from the structure of the balance sheet, was a primary driver of the incredible returns Dell generated for shareholders for over a decade. This is the power of reading the fine print. We have now journeyed from the discovery of float to its mechanics, from its application beyond insurance to the forensic methods for finding it on a balance sheet. This brings us to the final and most important pillar of the entire system: what to do with the money. Having access to a giant, low-cost pool of capital is a powerful advantage, but it is only half of the equation. A fool with a great tool is still a fool. The ultimate expression of the Berkshire Hathaway model is the fusion of its incredible funding advantage, the float, with the unparalleled genius of its central command. Warren Buffett, the master capital allocator. This final chapter explains how the float is not an end in itself, but the fuel for a compounding machine, a system for converting temporary cash into permanent value. The foundational anecdote that perfectly captures this synthesis of float and capital allocation is the acquisition of the Burlington Northern Santa Fe (BNSF) Railway in late 2009. The timing is crucial. The world was still reeling from the Great Recession. The financial system had nearly collapsed just a year earlier. Fear and pessimism were rampant. The stock market was recovering but still fragile. It was a time of profound uncertainty. In this environment, Buffett made what he called an quote-unquote all-in bet on the American economy. He orchestrated a deal for Berkshire Hathaway to acquire the 77% of BNSF it didn't already own, a transaction valued at $44 billion, Berkshire's largest acquisition ever. What enabled him to make such a bold move at such a precarious time? The float. Berkshire didn't have to go, cap in hand, to nervous bankers to borrow tens of billions of dollars. They didn't have to sell off large portions of their existing stock portfolio at still depressed prices. They were able to fund a significant portion of the deal with the cash on their balance sheet, cash that was a direct result of the massive, stable, and permanent capital provided by their insurance operations. While other companies were hoarding cash, laying off workers, and trying to survive, Berkshire was on the offense, using its structural advantage to buy a wonderful, irreplaceable asset at a fair price. BNSF is a perfect Buffett-type business. It's a critical artery of the American economy, has a durable competitive advantage due to the impossibility of building a competing railroad, and it generates tremendous amounts of cash. The acquisition was a masterstroke of capital allocation. It took the soft asset of insurance float and converted it into the hard asset of 140,000 miles of steel track, thousands of locomotives, and a permanent claim on the future prosperity of the country. This single transaction demonstrates the entire Berkshire system in action. Use the disciplined, low-risk insurance business to generate low-cost capital, and then redeploy that capital with immense patience and rationality into high-quality, durable operating businesses, especially when fear grips the market. The underlying psychological principle that makes this possible is Buffett's triumph over hyperbolic discounting. This is the cognitive bias where people tend to have a stronger preference for rewards that are closer to the present time, even if they are smaller, over larger rewards that are further in the future. It's why people choose to spend money today rather than save for retirement, or why they'll accept a small, immediate settlement rather than wait for a larger one. In a market crash, hyperbolic discounting runs rampant. The reward of stopping the immediate pain of seeing your portfolio decline feels incredibly urgent and valuable. So people sell. They choose the small, immediate reward of safety and cash, heavily discounting the massive future reward of owning great businesses that they could buy at bargain prices. They can't handle the short-term pain for the long-term gain. The structure of Berkshire Hathaway, specifically the nature of its float, acts as a psychological circuit breaker against this bias. Buffett is not managing hot money from flighty investors who can pull their capital at any moment. The insurance float is permanent capital. The policyholders can't just decide they want their premiums back tomorrow. This financial stability provides the psychological fortitude necessary to act rationally. Buffett doesn't have to worry about meeting redemptions or satisfying panicked clients. The float removes the pressure of immediate needs, allowing him and his team to focus entirely on the long-term intrinsic value of the businesses they are buying. He is playing a different game with a different time horizon, enabled by a different capital structure. The float is not just a financial tool, it is a psychological one. It is the bedrock of stability that allows for supreme rationality when irrationality reigns everywhere else. So how can an individual investor apply this grand concept? We can create an applied mental model called building your own Berkshire flywheel, on a much smaller scale, of course. Step 1 is to reorient your investment philosophy. Prioritize identifying and owning businesses with float-like characteristics, the durable subscription software companies, the retailers with negative cash conversion cycles, the dominant franchises that collect cash up front. These companies should form the core of your portfolio. They are your personal insurance group, providing a stable, self-funding capital base. Step 2 is to change your mindset about the cash these businesses generate. Instead of just consuming the dividends or celebrating the stock price appreciation, view the free cash flow from these core holdings as capital for redeployment. This is your personal float. Step 3 is to do the work when markets are calm. Create a watch list of 10 to 15 other high-quality, wonderful businesses that you would love to own but are currently too expensive. These could be in different industries, but you should know them inside and out. Understand their competitive advantages, their management teams, and their long-term prospects. Determine a fair price at which you would be thrilled to buy them. Step 4 is the most difficult but most important. Practice patience. Wait for the inevitable market downturn. When the headlines are screaming, when fear is rampant, and when others are panic selling, that is your moment. Consult your watch list. Step 5. Execute. Use the cash generated by your stable float-like core holdings or new capital you have saved to begin buying shares in the wonderful businesses on your watch list that have now fallen to your predetermined fair prices. By doing this, you are mimicking the Berkshire system. You are using a stable capital base to opportunistically acquire great assets when they go on sale. You are turning the market's fear and short-term thinking into your long-term advantage. This disciplined process of building a stable core and patiently redeploying its capital is the essence of building a personal compounding flywheel. The antithesis of this masterful approach to capital allocation is a dual-headed monster that has destroyed more shareholder value than almost any other force in business: the dividend chaser and the diversifier. The dividend chaser represents a segment of investors who misunderstand the purpose of a business. They demand that companies return all excess cash to them in the form of dividends immediately. They would rather have $1 in their pocket today than allow a talented management team to reinvest that dollar at a high rate of return for the future. Had they been in charge of Berkshire, they would have demanded that the profits from National Indemnity be paid out as dividends every year, starving the company of the very float that became the seed of its greatness. They prioritize immediate gratification over long-term value creation. The other head of the monster is the diversifier. This is the empire-building CEO who has access to cash flow but lacks the discipline and rationality of a Buffett. Driven by ego and a desire for scale, they use the company's cash to make a series of foolish acquisitions, often in unrelated industries they don't understand, and almost always at inflated prices. They call it diversification, but Charlie Munger famously coined the more accurate term, diversification. They take a wonderful core business that generates cash and dilute its excellence by bolting on mediocre, overpriced acquisitions. Both the dividend chaser and the diversifier fail to grasp the sacred duty of a capital allocator, to deploy each dollar of retained earnings in a way that generates at least a dollar of long-term market value. They waste the precious fuel of free cash flow, either by giving it away prematurely or by pouring it into inefficient engines, ultimately destroying the compounding machine. The ultimate direct financial connection, the final proof of this system's power, is the chart of Berkshire Hathaway's book value per share growth versus the performance of the S&P 500 over the last 50-plus years. The outperformance is a testament to the power of the entire system we have deconstructed. It is a visual representation of what happens when a massive, low-cost funding advantage is combined with a rational, patient, and brilliant capital allocator. From 1965 to 2022, Berkshire Hathaway's book value per share compounded at an annual rate of 19.8%, compared to just 9.9% for the S&P 500 including dividends. This difference, compounded over nearly 6 decades, is the difference between a fortune and a rounding error. A single dollar invested in the S&P 500 in 1965 would have grown to about $247. A single dollar invested in Berkshire Hathaway would have grown to an astonishing $3,787,464. This is not a typo. That is the power of compounding a structural advantage. This chart is the final word. It demonstrates that Berkshire's success is not just a story of savvy stock picking. It is the story of a superior business time system like Quennard. The float generated by the insurance businesses is the fuel. The disciplined, opportunistic capital allocation strategy is the engine. The combination has created a financial result that is without peer. It is the ultimate manifestation of how taking a liability that everyone else sees as a negative and turning it into a perpetual asset can become the foundation for building one of the most valuable and admired companies on earth. You have just invested a significant amount of your most valuable asset, your time, to download a powerful new mental model into your operating system. You've moved beyond the surface-level chatter of PE ratios and daily stock prices and into the deep structure of business. You now understand the concept of float, the hidden engine that powered the greatest wealth creation machine in history. You can spot its characteristics, not just in insurance, but in software, in retail, and in other dominant franchises. You possess the intellectual tools to analyze a balance sheet and find the companies that are built to win, the ones that use other people's money to fund their own unstoppable growth. This is a profound and permanent upgrade to your financial acumen. But what we have just assembled is a single, incredibly powerful gear in a much larger, more complex machine. Warren Buffett's success is not the result of one mental model, but a latticework of interconnected principles. The ability to harness float is his financial superpower, but it is magnified by his understanding of competitive moats, his framework for thinking about market psychology, and his deep-seated principles of temperament and patience. Each model connects to and reinforces the others. Understanding float without understanding how he evaluates the businesses he buys with that float is like having a powerful engine without a chassis or a steering wheel. You have the fuel source, but you don't yet have the complete vehicle. The video that is appearing on your screen now is the next piece of that vehicle. Think of the knowledge you've just acquired as one crucial coordinate on a map to financial freedom. That next video is another. It might be the piece that connects the how of float to the what of competitive advantage. It might be the link that explains the psychological discipline required to deploy that capital during times of panic. You don't know what it is yet, but the algorithm does. It has identified the logical next step in your journey, the missing link that will connect what you've just learned to a new, equally powerful concept in this latticework of wisdom. The choice to click is not about watching another video, it is a decision about who you want to become. Are you a passive consumer of information, Or are you an active builder of a complete mental arsenal? The 99% will click away. The serious player, the one committed to completing their map and mastering the entire system, understands that the learning journey is never over. Continue your ascent. Complete the machine. The next link awaits.